Good evening, everybody. It just happens to be coincidental that we've released our results today. So I've got a slightly modified investor presentation that I'm going to use for you tonight. So what do we do? We've been around for 18 years and we do a full range of what we now call cybersecurity. When we started, it wasn't called that. When we started, it was called IT security, which was vaguely interesting. And then it got really boring because it got rebranded as information security, which is a bit dry and feels more like something that people in governance deal with. And then the word cyber was added a few years ago and it became sexy again. So we like cyber security. In the same way as our machine learning, as we prefer to call it, we now call it artificial intelligence. Because if you call it artificial intelligence, people get all excited about it. If you call it machine learning, they don't really know what you're talking about. So the things we do, there's a side of the business that's time and materials. So that is the easiest one to understand is emergency response. So somebody's getting hacked and they call us out and we diagnose the problem, work out how they're getting hacked, work out how people got in, work out how long they've been getting hacked for, because many people don't have any way of detecting a breach. So they'll call us in to deal with a breach and we'll deal with it and they'll say thank you very much and we'll say no, we've only just started because we've dealt with this breach, but we need to work out how they got in because you might have had other breaches. So we dealt with one recently where their systems have been open for 12 months and there were more than 50 different breaches that they were unaware of. And the last major one before that, their systems have been open for 3 years and things have been undetected. So we deal with that emergency response, and that can be a technical response, anything from guiding them over the telephone to deploying people on site, sometimes for a couple of weeks. And we have a rack of equipment, one in the north of England, one in the south, and there's about £250,000 of equipment. We can wheel that in, plug into their network, and connect them back to our security operations centres. So this is a picture of our security operations centre. This one's in Bradford in Yorkshire, and we have another one in Brisbane, Australia, so we can monitor 24/7. So we can connect people in an incident back to the security operations centre, and then we can help diagnose and solve the problem they're in. So that's an easy one to understand. We also do general cybersecurity reviews, helping people understand what level of vulnerabilities they've got, and those are targeted at business owners and directors. And you can tell that because the first 7 or 8 pages are pretty pictures. So we take all the complexity of cybersecurity and we draw a nice picture and the directors go, at last I understand what state our security's in. Then there's another 60 pages of technical information for the people who need to fix the problem. There's then some standards, established international standards such as the payment card industry standard, ISO 27001. There's a UK standard, Cyber Essentials, you may have heard of. So we get involved in helping people get certified to those standards. And then we have testing, which in the industry we call penetration testing. And the best way to understand that is people pay us to be the hacker. So they pay us, we hack into their systems, and then we give them a report showing them how we've done it. And then we help them fix those things. So that's the time and materials consultancy side of the business. And then we have managed security, where we're remotely managing elements of people's on-site security. And the biggest growth area there is our ability to manage 24/7 and detect breaches. So most people don't have the capability to detect breaches. If you're going to do it 24/7, you need at least 6 full-time, highly skilled engineers. So recruiting and retaining those people is quite a challenge. If your IT team is less than 100 people, it's very unlikely you can do that. And in today's employment market and demand for cybersecurity people, also recruiting people who are willing to work nights is really difficult. And surprise, surprise, hackers tend to hack you out of normal hours. There's 2 theories. One is they'll attack you when your defences are low, and the other theory is they're attacking you when they're not at school. But either way, you see peaks of hacking, evenings, weekends, bank holidays. So the last significant breach we dealt with, the most significant one in 2018, the alert that triggered that was 2 a.m. on a Sunday morning. And many businesses don't have anybody monitoring and looking for things at that time. Hence why we have the facility in Brisbane, so we've got people working fresh, normal day hours that can cover us when we're not working in the UK. So that's the range of things that we do. The market The market's estimated at 3.3 billion in the UK. So although we've worked in over 30 countries and we've got the facility in Australia, we only do sales and marketing activities in the UK. We often win international clients who will ask us to go around the globe doing things for them, but we're very much a UK-based company. Proliferation of breaches is getting it more on the strategic agenda, and the legislation last year, GDPR, which you'll have been sick of because of all the emails you got trying to get you to reconfirm your details, which by the way was not a requirement of GDPR. That was some lawyers who just overinterpreted the requirements of GDPR. If you'd acquired data in a legal way, then you did not need to go back and ask everybody for reconfirming that you had their details. So there was a big overreaction to that. But what many people didn't realise is there's two halves of GDPR. One half is doing legal things with data, and the other half is cybersecurity breaches. And the cybersecurity breaches, that has fines of up to 2% of global turnover, and as yet, those fines haven't started. So it takes the Information Commissioner typically 18 months to 2 years to issue a fine following a breach, and the law only came into place in May last year. So 2019 is the year when we'll start to see the first fines coming through. So the big difference there is you've got fines of up to 2% of turnover, and you've got a mandatory reporting of breaches. So prior to May last year, 99% of all breaches we dealt with were kept in the private to the company. They were kept confidential. So I think at that point we'd done incident response for 17 years, and we only had 6 breaches that ever got in the public domain. And now you've got a legal requirement to report to the Information Commissioner within 72 hours, hence why people are giving this more priority. So the financial performance we've reported today for the full year, our revenue grew by 35% to circa 5.4 million. Last year it grew by 9.5%. The Managed Services division, which incorporates the recurring revenues for managed services, they're typically 3-year contracts in the range of £100,000 to £400,000. That division grew by 56%. The consulting division, typically £5,000 to £50,000 a year, that grew by 27%. And because we'd done some cost cutting last year and got our costs down, our gross profit as a result grew by 67%. Our long-term growth averages about 20. So if you look at our 5-year, 10-year, 15-year, it always averages to 19, 20%. And the market is estimated at growing at 10%. So historically, we grow at twice the market rate, and all that growth is organic growth. EBITDA loss was 0.6 million. So when we floated, we raised cash, and we used that to expand sales and marketing and also redevelop the security operations centres in the UK and establish Australia. So prior to that, we served out of hours by having on-call people. But the business is growing so much, and the need for that 24/7 monitoring, we need that extra facility around the globe to be able to do the 24/7. The EBITDA loss of 0.6, that roughly translates to a loss of 300k in Q1, 200k in Q2, 100k in Q3, and break even slightly into profit in Q4. So that's the profile that we achieved last year. We secured 95 new consulting clients. That's significant because it's extremely rare that we sell a managed service as the first service into a client. So the business model is acquire clients, do some consultancy, and then develop the relationship, show them how good we are at what we do, and then move them into a managed service client. And that may take a couple of years to achieve that. Where that can be quicker is a managed service, is when somebody's got an incident. In an incident, people tend to invest quicker in cybersecurity. It tends to focus minds. We dealt with one incident last year of a company that's got a 2.5 billion turnover. And later, when we'd finished dealing with the incident, the CEO told me they were within 48 hours of going bust. And that's a 2.5 billion turnover company. So the strategy is land and expand. And a new development this year is we've now launched a partner program. So this was only launched at the end of Q4 last year. But the program there is to allow people to resell our services. to expand the growth. And there's two parts to that. The first part is we're recruiting resellers. So typically a value-added reseller, anything from 1 to 100 salespeople. And we're adding those at the rate of about 10 partners a month. And we're directly managing those. We've also signed a deal with a distributor, and they're bringing on board 500 active partners who buy from them every month. And they're a distributor who focuses on the cybersecurity sector. So we've got 500 partners at arm's length, and we're building up to 200 partners over the next 2 years that we're dealing directly with. So that's a key thing for this year, and we'll be reporting what that's contributing to revenue when we do our half-year results, which will be in September as usual. And then, as I said, our machine learning, which we now call artificial intelligence, we continue to invest in that. Prior to IPO, although we've been investing in our own technologies for 19 years, we expensed all that development. So it was only with IPO and having to do IFRS, etc., that we started putting development on the balance sheet. So there's a lot of development historically that's been expensed, so you don't see that in the balance sheet as you would if we'd just acquired that. That's our graph of growth. That's the average 20% growth a year. There's an adjustment for 2016 because prior to IPO we did a 15-month year. So some people look at the headline results and say, oh, you shrank in 2017, but we didn't. It was because 2016 was a 15-month year. But that's our growth profile. As I say, all organic growth and averaging 20% a year. In the interims this year, we started to establish KPIs. So we learned from year one as a floated company, what are the key indicators that the investors are interested in and give good visibility on how we're performing. And we came up with these as the headline KPIs, which we're happy to share. So revenue growth is obviously, as a growth company, that's a key one for us. There's some restatement of 2017 due to IFRS 15. And what that means is that traditionally, if we've got a managed service contract, let's say it's £400,000, a traditional profile is £100,000 of setup and hardware and installing our equipment, and then £100,000 a year for 3 years. It's typically a 3-year contract. Under IFRS 15, unless you play silly games and try and pretend that upfront is consultancy and it's not really part of the managed service, then what you've got to do is spread all of the 400,000 over the full 3 years. So that's what we do. So we don't try and pretend that some of it's consultancy. So a managed service contract, we have to adjust, and we adopted that from the 1st of January last year, so we had to adjust the year before to give like-for-like comparison. So revenue growth's gone from 9 to 35. The recurring long-term, typically 3-year recurring revenue contracts, that's grown 46% as opposed to 25%. The proportion of our revenue that makes up has gone up to 29%. And we now calculate an order book for managed services, which we hadn't done previously. And this is the amount of monthly revenue under IFRS 15 times by the length of the contract. And that's a really good measure of the performance of managed services, because there's only 2 ways you can grow that: either renew or expand and develop existing clients or win new ones. So it gives you a good insight into what's there coming for the future. And then two levels of gross margin. Managed services grew from 33 to 53. Now, if you looked at the interims, you see for the first half of the year it was mid-40s. So if it's mid-40s for the first half of the year and it ends up at mid-50s for the year, it tells you the second half of the year was actually over 60%. So we can leverage quite a bit of capacity on managed services, because moving from 40 hours a week, which is what you do when you work business hours, to 168 hours a week, where you've got 2 facilities and you're working 24/7, that requires quite a lot of staff to handle the rotas and cover those time and that time frame. So we've got a good amount of leverage we can do there in terms of adding new contracts and not bringing people in at the same rate. We also measure on the consulting side, even though we grew consultancy by 27%, we also measure how much of that consultancy was from clients who'd bought in the previous 2 years. So it's not contractual recurring revenue, but it's quasi-recurring because it's clients who typically buy every year. So for example, one of our clients, we've managed their ISO 27001 certification in 5 countries for the last 10 years. Every January they give us purchase orders to manage that for the next 12 months. But it's not a managed service from the Security Operations Centre, so we don't class that as recurring revenue, but it's repeat revenue because it tends to repeat every year. Consulting margin grew from 50 to 57%. We don't expect that to change very much. If you try and squeeze your consultants too hard, then they'll just leave. Our top consultants will get a job offer every day. That's how buoyant the cybersecurity marketplace is. So recruitment and retention is key for us. And if you don't know how to treat consultants and give them an appropriate level of challenge, but also not too much workload, then you'll just lose them to competitors. So we've got a good track record of recruiting and retaining people. So out of 80 staff, we've actually got 3 who've left and come back. And that's always a good indication. And our retention ratio tends to be upper 80s to 90%. So for a technology company, we've got a very good staff retention ratio. So that margin there, if we're growing at more than 20% in the consulting division, then we wouldn't expect to squeeze much more out of that. So you can expect moving forward pretty static consulting gross margin, but increases in the managed service gross margin. And then deferred income is made up of people who are receiving a managed service who've paid for something in advance. There may be an element that they pay annually, or some people will buy consultancy as an upfront block of consultancy, and we only recognise that as we deliver it. So that it's a useful measure of what orders are in the pipeline. So the outlook, first one is the GDPR fines. So they'll start coming through this year. So we need to see, does the Information Commissioner start issuing fines up to that level of 2% of turnover? So that's a theoretical maximum, but we'll see what happens this year with that. Our primary strategy is still organic growth. We average 20% a year, and this year we delivered 35%. So that's our primary strategy. We will look at acquisitions if we think they offer value, but our track record is delivering organic growth. So that's our primary strategy. Keep that focus on managed services, growing that ahead of consultancy, but consultancy being really critical because that's where we win the new clients. So the two dovetail together nicely, and leverage that capacity, particularly on the managed security side. Progress towards profitability. We've finished all the investments post-IPO, and then the sales partners, that's a new channel for us in terms of developing and winning new clients. And we'll start to report that in the interims and report how that's progressing, both in terms of number of partners and percentage of revenue that's flowing from those partners. So, summary, cybersecurity, key risk issue for boards. So if it's a potential 2% of turnover, then it's a material risk that needs to be on the agenda of every board. We're a proven provider. We've got the full range of services. We've got good demand from clients, new and existing. We've got the new regulatory framework. We've got our own technologies, and we've got the organisational changes, the infrastructure and the people, and a good management team as well.
I heard you say the words that you were profitable in Q4 last year. Are you inviting us to assume that you've reached break even and that your internal forecasts are that you're going to be profitable every quarter going forward?
Yeah, if you look at I'm not going to talk too much about internal forecasts, surprise, but if you look at Allenby, who's our broker, they make public their research notes, so you're all free to look at that, and you'll see that they have us moving into profit this year and generating £1 million of profit next year. So we're very comfortable with their forecasts.
Is that profit on a cash basis as well? Because I can see that the cash at year end, net cash was about £650,000, which looks a bit tight.
Cash pretty much follows EBITDA. It's a pretty simple business model. So if consultancy grows ahead of managed services, then you've got a bit of a working capital requirement because consultants like to be paid. So you're paying them for a couple of months before you get the money for the work they've done. So a bit of working capital for consultancy. Managed services, if you remember, typical managed service contract, a quarter of it is billed up front. So managed service wins tend to be cash positive. Consultancy growth tends to be a little bit of working capital. And because we're growing both, they tend to balance out. So very roughly, our cash tends to just follow our EBITDA. So we're very comfortable with our cash position. It's in line with budgets. So I don't know the exact number that Allenby have got, but my best guess is I think they've got cash growing to 1 million by the end of this year. So we're very comfortable with our cash position.
Just wondered what your BHAGs are. Your, what are your big, hairy, audacious goals? Because this is a very small company, and if it's taking you 20 years to get to 5.5 million, what does the next 5 years hold?
Yeah, but I did start it on a credit card. So prior to IPO, we'd literally, total investment was less than £100,000. It was my credit cards and a few bits and pieces from family and friends. So at the moment, it's growing organically. We've got a great client base, including 10% of the FTSE 100, and we've got our own IP, our own technology, and we're growing at twice the market rate. So at the moment, we've got a very good company. We could risk lots of acquisitions and do them badly. A lot of our competitors have done that and been stung. We think if we can deliver results like this, we've got a very good investment for people. So that's the strategy.
So what sort of profitability could one look forward to in, say, 3 years' time if the thing's growing at, 25% did you say a year?
Long-term average is 20%.
20%.
Allenby are forecasting 2020 at 7 point something million revenue and 1 million profit. Prior to the IPO investment, prior to the IPO, we were achieving about 15%.
Because you were very profitable a few years ago, weren't you? I noticed.
Yeah. So 15 to 20% is a reasonable amount, but it also depends on how much we're growing. Obviously, we could sit there and squeeze the consultants and squeeze profit if we were trying to be acquired. But equally, if you're going to manage growth and manage it and maintain the quality, which is why we're successful and grow every year, then you can't squeeze too much profit. So it's getting the right balance.
And did I notice that your recurring revenue is about 29% in total?
Yes, that's the recurring, that's the contracted managed service, not the repeat from the consultancy, but the recurring element. And that's
so how much is your recurring revenue as a bald figure?
So it's the 29% of, so it's the 29.
Of your 5.5 million turnover, how much is recurring?
The 29%.
29%. And can that grow substantially more than that? Because City loves recurring growth.
Yeah, absolutely. And that's the key strategy, and that's why the results are good for us, because the division that sits in has grown by 56%. And the bit that's not recurring is incident response, and that was less than £300,000. So we're achieving the growth in the area that the city likes.
Clearly, this is a very hot market. Skills are at a premium. Are you going to be constrained by getting on the right people with the right expertise?
Well, it's a double-edged thing, because Lucy, our COO, is sat at the back, so I could refer to her. But Lucy recruits and retains the people. That's her forte. She looks after all the consultants. Her top consultants get a job offer every day. So that's the reality that we deal with, which is why the fact that Lucy and myself did consultancy for 10 years, we know how to retain the interest and the challenge, but not overwork those consultants. But for every difficulty you get in returning key people, it means our clients are having the same difficulty, but more. Because working for us is very, very interesting. If you're a consultant, you're dealing with a different person every week. You're not trying to solve the problems of that bank that are not solvable and banging your head against a brick wall. If you're an engineer doing managed security, if they work for a single organisation, if the organisation's good, they might not have a breach for until once every 2 years. If they work in our security operations centre, they're dealing with breaches every week. So as long as you pay people appropriately and you know how to treat them and retain them, it's actually a really interesting job. So we've got an advantage. So the tougher the market gets for people, the more people want to outsource. So as long as you know what you're doing, and that's the advantage that we've been doing this for nearly 19 years, we know what to do with that. So what Lucy typically does is target companies that have just been acquired. Because typically when they get acquired, the people who've acquired them don't know how to manage them, and you see an outflow of talent, and that works for us. But yes, it's a key challenge. It's one of the key things you've got to get right in this business.
Ian, the introduction of GDPR was a bit of a one-off event last year. It's not going to happen again. And it coincides with a growth of 35%, which is way above your historical average. How much of that 35% do you think was due to companies preparing for the introduction of GDPR?
I'm going to ask Lucy, but I think it's less than £100,000. Yeah, it's very small, because the flurry of activity last year was people trying to sort out where they got their data from. So one of our clients had 1,000 databases, and they were trying to work out where it all came from because nobody knew. But you don't need cybersecurity experts for that. So the sort out your data was a flurry of activity, mainly mopped up by law firms who overstated the requirements. The cybersecurity bit is a slow burner because there's been no impact yet. So you've got guidance of what you should be doing, and if you read the guidance on the Information Commissioner's site about what you should be doing in security, it very much matches our services. But because the fines haven't started, then we haven't really seen the activity there. So other than the fact that you've got an increase in awareness, then I don't attribute this year to GDPR.
Ian, just to help me understand what the key levers are that make you grow at double the rate of the market, from what you're telling us, is what are the key competitive advantages that you are most desperate to protect, encourage?
I don't like USPs because it tries to encapsulate all the different things you've learned in 18 years and simplify it into some really simple headlines. The way I look at it is all the things we do well are all the things we learn every year that moves us to the next step. So having done consultancy for 10 years, we know how to treat consultants. Because we've done it for so long, we understand that when that latest technology comes along that everyone gets excited about, we've seen it before. Because we saw it in 2001 and we saw it again in 2005, and so we're sceptical about the latest new whiz-bang technologies. But we've got that longevity, but we've also got, so part of it is just that experience and all the knowledge you built up through that time, and then the other thing is our intellectual property, our own devices. Because a typical managed service, people take some technologies that are actually designed for individual companies to use for their own security, and they try to deliver a managed service, and it's not scalable. So I've got one client who had 5 managed service clients, and to deliver 5 managed service clients, they had 4 different systems, which is just not scalable. Because we built all our own technologies from the ground up to be a managed service, you cannot buy our technology to manage yourself. And that's its merit. Its merit is it only works in a managed security setting. So everything is designed to be scalable and to be managed as a group. And to give you an example of what that technology does, the people here, so the engineers have each got 6 screens, and we've got some big screens on the wall. And this is in Yorkshire, and you can come up and visit the Security Operations Centre if you're interested there. But our artificial intelligence, a typical client will send us in the order of 5 billion IT logs in a month. So we get 5 billion pieces of information. The artificial intelligence takes that and translates it into roughly 200 alerts. Now, if you buy some software to do this yourself in-house, that's what you get. If you know how to manage it properly, it takes 5 billion things and translates it into 200 things. But then your team has got to work through and understand those 200 things, and they get bored. And within 6 months, well, probably within 6 days, they're not looking at them anymore. And then when you do have a breach, you had the evidence, but you didn't spot it. So what we do is we take the artificial intelligence, takes 5 billion things, translates it into 200 things, and then the engineers analyse those 200 alerts and then decide what needs to be investigated. And they'll typically raise 1/10 of those with the client to investigate, and they might spot a breach within one of those. So the machine learning, artificial intelligence part translates all that information down to a level that people, real intelligence, can then apply that experience and intelligence to understand, and then work with the client to decide what to do with that information.
And just supplementary on that, I get that. So it's about looking after your consultants, making sure that they're fed and watered and all the rest of it. That's key. And you're also saying that your machine learning element that screens difficult areas down to a manageable number.
But you've got to call
would I not be able to find that from any of your competitors?
Everyone's got their own flavour, and everyone calls it artificial intelligence, and everyone tells you they've got the best in the world.
Right. Okay.
But the reality is, what does it deliver? So when we do an incident response, in many cases, they'll have one of these fancy detection systems, and we will be able to show them how 3 months before the incident, it did tell them about the breach, but they didn't notice because there's too much noise generated. In the industry, we call it false positives. So if you don't have the skilled people looking after it and monitoring it and looking at the results, then you miss things. So we think artificial intelligence is great, but you need an intelligent person at the output. So the media overhypes artificial intelligence as if it can replace people, but it can't. It helps people, but it doesn't replace them.
You mentioned sales partners. What sort of people did you have in mind? What sort of companies do you have in mind, and how do you see that working in practice?
Typically value-added resellers, but they can be anything from a one-person company and a consultant up to a value-added reseller with 100 salespeople. That's the sort of range. And it's very simple. Half the services we allow them to sell direct because they're reasonably simple to sell. Half the services they have to refer it to our sales team because it's a complex consultancy sell. And that's how it works.
So at the moment it's all in-house?
Yes. To date it's 100% in-house, yeah.
Fantastic. Ian, thank you very much indeed.
Thank you very much.